Okay, it is 5 o'clock, so let's get this thing started promptly for those that showed up on time. Hello, everyone, and thanks for coming. We're going to get started, and tonight we are presenting the Five Oaks Apartments, a Class A 228-unit multifamily property located in Cypress Station, a submarket of Northwest Houston. So first, a quick disclaimer. We're presenting information that we've gathered through our due diligence. You are encouraged to do your own due diligence. This is not the official offering. That will all occur within the investor documents, meaning the private placement memorandum and the subscription agreement. And we will let you know how you can get access to that on the portal toward the end of the presentation. So first I'm going to introduce myself. My name's Rick Martin. I'm a co-sponsor on this deal. I'm with Fortress Federation Investments, and I myself have been investing in real estate since 1997. Founded Fortress Federation Investments, and we've been providing value-add multifamily investment opportunities in the Sunbelt states to help investors build wealth and income streams. Our portfolio is approaching 1,800 units, and I invest passively a lot myself, not only in my own deals, but other deals as well. I have a background in entertainment advertising, and I kind of lean on that to provide education. So if you're not coming onto the website, do so at www.fortressfederation.com, and you'll find a bunch of videos and written content there. So before we jump in to the presentation itself, just a quick macro view of economics right now, and sort of addressing the elephant in the room, which is these rising interest rates everybody's talking about. I actually did a video on this last week. Some of you may have caught that, but this is a graphic from Freddie Mac, and it shows the very, very intentional upward and downward movement of interest rates by the Fed. The movement up is the Fed implementing its quantitative tightening by raising rates. And then you can see by these gray areas, which are actually recessions, they sort of reach a threshold, and then there's a rather steep decline, and they're letting off the gas, and they're going back into quantitative easing and lowering interest rates. So, a lot of people fully expect that this pattern over, which has reoccurred over history, is going to continue. And you can see that these periods, these gray periods in between the high interest rate and the low interest rate are not that long, meaning, maybe a few quarters, a year and a half at the most. So, it could be a very positive scenario with a deal that would be getting around this time, and timing it with the business plan. In a couple of years, or 18 to 24 months after the business plan is complete, the renovations are complete, generally you go out, you seek a refinance, and based on history, interest rates could be pretty attractive, which could be a scenario where we're pulling back out investor capital, returning that, keeping investors in the deal, but at a much more attractive interest rate and improving the cash flow. So that's what I think, and that's what this guy here thinks too. He says, take a pause on buying homes, people, or getting in the market. We need to get back to a place where inflation is down low again and mortgage rates are low again. So he's basically telling us that interest rates are going to come back down. And, there's just some other economic fundamentals. There was a massive amount of overbuilding preceding the last recession. Coming out of that recession, there was actually no building. The market was spooked, and it took a while for it to get going. We never even got back to average, and this has resulted in a cumulative, historic shortage of home supply. And so you have all these people that want to buy homes but can't. So what are they doing? They're renting, and so this has flooded an already healthy rental market, and it's driving down vacancy, it's driving up occupancy, and it's been driving up rents as well. So you can see, in addition, inflation hasn't been hurting rental rates either. Could these interest rates dampen the market? Yeah, in the near term, but I think in the long term, we're going to go back to that up and down sort of pattern that we saw. Just a little bit more. Here's that, cumulative shortage that we talked about. Historic shortage. We're about 6 million units short of supply. You combine that with record amount of money. This is COVID, this yellow area, where just a tremendous amount of money was printed, and all this money is seeking investment, and a big portion of that investment is real estate. So it's a very healthy real estate economy now, and despite all the fear and that you see, that's kind of the panic of the stock market. I don't think it really relates. Again, there's an adjustment going on. There's a bit of dampening, but the future, I believe, is bright. So with that, we are going to get to the presentation of the Five Oaks, and we're going to bring on Mr. Rob Beardsley from Lone Star Capital, who is the operating team on this. I'm proud to say that this is our 5th deal partnering with Lone Star Capital. So Rob, go ahead, turn on your video if you would, and introduce yourself and take it away, sir.
Yeah, thanks everyone for being on. My name is Rob Beardsley. I'm the founder of Lone Star Capital. We're a multifamily owner-operator focused primarily on Houston workforce housing assets. We've completed over $300 million in acquisitions since starting the company in early 2018, and we're under contract to sell our 3rd successful round trip. And we also last year successfully launched our in-house property management company, Radiance Living, which is based in Houston, furthering our focus in Houston with boots on the ground and vertical integration. And we're currently in the process of bringing construction management in-house as well, again, based in Houston. So our portfolio is almost 100% in Houston, and Five Oaks is a great addition to the portfolio. It's actually our youngest property in the portfolio. It's built in 2008. So a little bit more about Lone Star. I gave the introduction about us, and over 300 million acquisitions. The 3 exits, 2 and 1 pending, will have resulted in an average return of over 30% IRR. And as I mentioned, we have Radiance Living based in Houston. This was a project that we had in the works for almost 2 years, going from outsourcing management to bringing it in-house. And we're very fortunate to have kept a lot of consistency through that transition as far as the back office accounting, the HR, our key personnel, and the on-site staff. A little bit more about the investment team, the operating team here at Lone Star. I myself am one of the principals, with Kent Petrikovsky being the other one. Kent oversees operations and asset management with a background as a tax attorney. He had prior experience dealing with private equity transactions at MetLife, working at MetLife for 10 years. And myself, prior to forming Lone Star, I worked in my family's real estate businesses on the residential side in sales, development, and construction. And I oversee acquisitions and capital markets. So the responsibilities are well split up, and we have a really fantastic team that continues to grow, and it's a very exciting time here at Lone Star. So I'll cover this quick case study, which is relevant to Five Oaks, being that it's close by, also in a Northwest Houston submarket. And we did recently exit Verandas at Bear Creek in April of 2022. So we first acquired the property in June of 2019. It's a 160 unit, typical Class B property built in 1982. It was actually decently well renovated by the ownership at the time, but it was neglected from a management standpoint. So meanwhile, all the deals on the block were operating in the high 90% occupancy. This property was languishing in the low 80s. And it actually deterred a lot of buyers, because buyers didn't see a straightforward value add. They didn't see how they could renovate units, raise rent, or somehow fix deferred maintenance and raise occupancy. So it deterred a lot of buyers. The property sat on the market. We stayed consistent with the broker and the seller, and had the confidence to put the deal under contract finally, based on a business plan of operating the property better, marketing more aggressively to really fill up and really have the market occupancy and the best rents in the submarket. And that's exactly what we did. We took over at about 80% occupancy, raised rents to 100% at one point. All the while, the market performed amazingly, and we got rent growth in excess of our pro forma. And we were able to sell, as I said, in April for $17.5 million off of an initial purchase price of $11.5 million for a 36% gross IRR. So that was definitely an exciting deal. We held that property for almost 3 years, and we'll talk about some similarities moving forward. So Cranbrook Forest is a case study that shows kind of more of the renovations and value add side of things for us. It was also a heavy lift where we did raise occupancy a lot and have to re-tenant and fix up crime and deferred maintenance. But really, we also spent a lot of time and money on the interiors, and we're able to raise rent substantially through really going from classic to renovated units and upgrading dated interiors and exteriors on the property. This property we held for over 3 years, and we sold it on the last day of 2021 for a 23.6% IRR. And I'd say the other highlight here was we added washers and dryers into every unit, which is a value add that we're always looking for in our deals because it just creates so much value, attracts a higher tenant base, and calls for more sticky tenants. So you can look at this more in depth offline, but here's a slide, page 17 of our track record. You can look more in depth on our completed acquisitions to date. So jumping in finally to Five Oaks. As we mentioned, this is a Houston multifamily property built in 2008. It's 228 units, and it is really very clean, in perfect condition. It's a Class A property, and the units are split between 66% one bed and 34% 2 and 3s, and it has an average square footage of 716 square feet, which is a bit on the smaller side in this comp set. The story behind this deal is we were awarded the property after a long negotiation process, which was very unorthodox. We were initially the property was awarded to a different group at a higher price, but then they came back to us and awarded it to us at our discount, just because they were looking for certainty of closing over highest price. And the reason why I say it was unorthodox is because when they came back to us, they gave us the PSA, and they said, we're not awarding you the deal, but we want you to mark up our purchase contract. And based on how you mark it up, we'll see if you're a good partner to transact with, which is unusual. And in my opinion, not a great move, because we could have just sandbagged the markup and then came back with more red lines later. But they ended up choosing us, and we're glad they did. And I think definitely we were pushed hard by the brokerage group that represented the seller, which is Berkadia down in Houston. We've done well over 100 million in deals with Berkadia just in the last year or so. And every deal we've done with them, we've financed with them as well. So they love us, and they're a great partner. And so they push hard for us whenever we're bidding on their deals. As far as the business plan, we plan to take the property from its current partially renovated condition to a full premium condition across the interiors. And really, as I mentioned before, the property is in perfect condition. So the business plan is almost 100% focused on the interiors, with a little bit of capital allocated to the exteriors for some amenity touch-ups and any unexpected deferred maintenance. As Rick mentioned, this property sits in the Cypress Station submarket, which is close to a couple Amazon distribution centers and some other kind of employment hubs in the Northwest Houston area, and is like much of kind of suburban Houston, very accessible to the rest of the metro through main highways. Similar to our Verandas and Bear Creek property and Cranbrook Forest, Cypress Station and Five Oaks benefit greatly from the population growth that is occurring in Harris County, which the bulk of it is happening in the suburbs where we like to own and operate, which includes Five Oaks. To that end, this submarket has seen 11% rent growth in the past year, and Yardi projects over 4% annually through 2024 on a compounded basis. So I think it's something like maybe 6 or 7% over the next year, and then it drops to 5 and 6 and goes down, but stays an average over 4% through our projected hold period and beyond. With all that being said, we are projecting a conservative 15.8% net IRR for investors on this deal and a 5.5% average cash on cash over 3 years. And I'll dive into kind of one of the highlights that is missing on this page, which is the debt, which is also kind of a big topic in today's environment, as we all know. So I'll touch on the business plan in a second, but I do want to just jump into the debt since I mentioned it. We are going with a conservative low leverage bank loan at about 65.6% LTC, which really reduces our risk from a cash flow standpoint as well as from a refi standpoint, or really that exit test, which some of you may be familiar with. So not only does having lower leverage really help from a risk factor standpoint, it also helps with obtaining the best terms in today's market. Rewinding back, 4 months ago, the difference in terms and interest rate of a 65% loan to cost or LTV loan versus 80% was marginal. And so you saw most market participants lean towards the higher leverage because why not? It was cheap. But today it's the exact opposite in the market. 80% is very expensive, and the marginal cost is a ton. So it really makes sense to back down the leverage for cost purposes as well. So we're getting a very, very competitive interest rate of SOFR plus 2.1%. SOFR is a floating interest rate benchmark, which is essentially tied to the Fed funds rate. So the whole world's watching the Fed right now. Rates are going up, but they're also projected to start coming down in as soon as a year. So the other good part about a low leverage bank loan like this is that we have the 3+1+1 structure on the debt, which means there's an initial 3-year term on the loan with 2 1-year extension options. And we feel comfortable with this because the initial 3-year term allows us plenty of time to implement our business plan, create value at the asset, and then choose to either refinance or sell as appropriate based on property performance and market conditions. The extensions are there in case we need more time based on market conditions. And the other thing too is we don't have an onerous prepayment penalty because of the 3+1+1 structure and the floating rate loan. We're able to exit out of this loan for no penalty at pretty much any time. So as Rick mentioned earlier, if interest rates go down, we're benefited immediately because of the floating rate exposure. If spreads come down, which would be hard to imagine because we have such a competitive spread here at 2.1%, we could again refi and capture a lower spread at a later time. So that gives us flexibility. And then also one other scenario is we could simply implement the business plan, create value, and then choose to re-lever the deal and get a new loan at 65, 70, 75% leverage if we think the market environment supports that and the deal supports that, and take advantage again of that no prepayment penalty. So I think that's definitely a highlight of the deal is this conservative bank debt. And to add to the protections on the downside for this debt, we have a rate cap that we'll be purchasing at a 3.9% strike rate, which means SOFR equaling 3.9% is our maximum interest rate exposure. So if you have 3.9 plus 2.1, that's a 6% all-in pay rate. So 6% is our ceiling when it comes to interest rate exposure. And at that 6% rate, we still are cash flow positive, which is obviously very important in as far as downside protection. So going back to the business plan, 59% of the units are already renovated by the current ownership to a quartz and stainless finish with really not too many bells and whistles. And the rest of the units are in classic condition, which is very rare to find for a property this new. So that really gives you a big opportunity to create a ton of value from taking those classic units into premium units. So our business plan is to do just that and take the classic units to a premium finish, as well as the 59 partially renovated units to a premium finish as well, which we estimate will achieve an average over across all the units, a $150 rent increase, which is fairly conservative given the fact that the 59 partially renovated units are already commanding a $150 rent increase over the classic units at the property, which makes sense again because it's a 2008 vintage property. It's very rare to find those types of classic interiors in a Class A building like this. So just to recap the returns, as we discussed, we're projecting a 15.8% target IRR and a 1.53x multiple over a 3-year period. So if you're used to seeing a higher equity multiple or used to seeing higher average cash on cash, the reason maybe is due to the shorter projected hold period, and I'll touch on why that is. And then also the, forgot what I was gonna say, but the reason that we do the 3-year projected hold period is to match the initial term of the bridge loan to the underwriting. It's complicated to project a 5-year hold when you have a 3-year initial term because then you are, yeah, Jason, lower leverage, exactly. You might also be, you might also see lower returns here than other deals because when you don't lever up to the max of 80%, you obviously have lower projected returns, but leverage cuts both ways, unfortunately. And so in today's market, this is what we feel is the best thing to do, which is not an easy thing to do from anyone's standpoint, especially as a sponsor. We benefit from the upside, and but this is what we believe to be the prudent thing to do. So so anyway, back to the projected returns and the bridge loan, just to finish that thought. When you have that initial bridge loan, if you want to exercise the extensions, you sure can with the extension options, which don't cost very much, but it's not really your base case assumption. You don't go into a 3+1+1 bridge loan wanting to execute those extensions. Typically speaking, here we have a business plan to implement, we implement it, and then we refi or sell within a 36-month time frame. And that has been the case with all of our deals. All of our bridge loans to date, we've either sold or refinanced in 18 months. So while we're not projecting a refi in our model, it's certainly on the table, and that's why we do the 3-year hold. As far as the waterfall, we have a institutional type waterfall with an 8% cumulative and compounding preferred return. Second to a 100% return of capital, followed by a 70-30 split of the remaining proceeds, 70% to investors, 30% to the sponsor, and that goes up to a 15% IRR after investors have been distributed a 15% IRR. The remaining distributions are split 50-50, investor and sponsor.
Oh, you like that animation, Rob? It's pretty cool.
It's a lot fancier than mine, than my books.
To tell you the truth, I didn't even know that was going to occur, but it's a little bonus for the people.
It's a good bonus. So here's a look of some of the classic units and the anticipated upgrades as far as, on the far right, with the frame mirrors and hard surface countertops and new flooring, paint, hardware, lighting, and then in the kitchen, backsplashes, things like that. And then, as you can see, this is by far our prettiest property that we'll have in the portfolio. New deal, beautiful 3-story construction, got the attractive brick accents. Of course, being a newer property, it has 9-foot ceilings, which is really a must if you're trying to compete in the upper workforce housing space. And then also, we've got some pictures here of the luxury amenities. The pool, this picture doesn't do the pool justice. It's definitely a resort style pool with those cabanas, and it's not just your typical lap pool. It's got some flair to it. Business center, fitness center, barbecue by the pool as well. So again, there's not a ton to do. We think we can make some small improvements to the amenity set as far as the dog park and the pool furniture and some small landscaping, but all in all, it is in great condition. This is just the unit mix. You can see the current rents and where we plan to take them. And so here is a look at the Yardi projections as far as what has already occurred in the market. As we talked about, 11% trailing 12-month rent growth, very strong in the market. And the projections, got to go back here. And the Yardi projects another $160 of organic rent growth through our investment hold period. And of course, we are not projecting to that much in our underwriting. So hopefully we have some additional unfactored in upside in our projections. And as far as the area, we have the North Houston District, City Place. We're close to the Bush Intercontinental Airport, which is one of the busiest airports in the country. And the Woodlands, well, before you get to the Woodlands, this property is just a few miles south of Spring, which is a more affluent area, good quality jobs. You've got Whole Foods and Walmarts and things like that, and a Topgolf. And then if you go even further, you have the Woodlands, which is one of the nicest parts of Houston. And that's where you have, obviously very high-end homes. You have and high-end employers. So the way I look at Cypress Station is it's kind of nestled in between two paths of progress. To the north, you have Spring and the Woodlands. And then to the south, you have all the new growth happening in Greenspoint, which Greenspoint has historically not a very good area of Houston, but there's a ton of new jobs there. The Pinto Business Park, Coca-Cola recently put online a 1 million square foot plant and distribution center there. And there's also 2 Amazon warehouse distribution centers nearby as well. So Cypress Station in between the outward growth and all that growth from Greenspoint is moving up and to the left, up and west, which is certainly benefiting Cypress Station, and then coming down from Spring and the Woodlands, as well as, of course, not everybody can afford to live in the Woodlands, but plenty of people work there. So maybe they live in Cypress Station and commute up there. Here you can see a flyover look of Five Oaks. And this is, facing up. This is actually looking south. So you're not looking towards Spring, but looking towards rather Greenspoint and downtown Houston. And then this is looking to the north. You can see that the Woodlands is just up the 45, very commutable. Everything up and down the 45 is a really good place to be. And west of the 45.
Why would you say west of the 45, Rob?
That's just where the better pockets are, like right here-ish is, there's not the best stuff. Oops, I clicked.
Mm-hmm.
But when you're talking about this pocket, this is the best part of Cypress Station in particular. Mm-hmm. But even as you come down to Greenspoint, which is this intersection of Beltway 8 and 45, the better parts of Greenspoint are over here. Mm-hmm. This is really bad. Mm-hmm. And that holds true to a lesser extent as you move north.
Yeah. Gotcha. Thanks, man.
Okay. And then, we've got some rent comps for you and sales comps, which you can review in more detail if you'd like on your own. But just to give a quick view, the rent comps are pretty straightforward. You have properties in close vicinity, right in this little pocket, with number 4, Westmount at Hollow Tree Park is just down the road, and it's a nice property, and it's doing very well and has higher rents. And so really it's kind of our target comp and our competition, so to speak. On the sales comp side, we are acquiring this property at $143,000 per unit, which is a good basis on a price per unit basis, but you'll notice that it's high on a price per square foot basis. And this is something that Rick and I have discussed, and it's a function of the smaller units. As you can see in our comp set, the average units are much larger than ours. So when you compare a smaller unit, you get more rent per square foot and price per foot out of a smaller unit, which is going to show up in a higher price per square foot. But also it's going to kind of undersell the price per unit. So just, not one metric is the defining metric. When we look at values, we look at price per unit, price per square foot, and cap rate as really the top 3. And really, in my opinion, cap rate is by far the number 1. And not just cap rate, but also your projected, your future cap rate based on your business plan and your costs. But we do feel that our basis is quite competitive here. And we were able to secure the property at $500,000 less than the winning bid, which is definitely helpful. This is just a look at our pro forma. Again, you're more than welcome to look at it in detail. some things that you'll see based on the business plan. You'll see the gradual increase of gross potential rent through our renovations occur over the first couple years into year 3. Also, loss to lease. Pretty much every property these days has a pretty substantial loss to lease. And what that is the difference between market rents and where the lease rents are signed at. And that's a function of velocity. When the market is growing as quick as it is, for example, average 11% rent growth, of course, that doesn't happen in a smooth line. And you can't do it in a smooth line because you have 12-month leases. So if you signed a lease in January and then across the whole year you experienced 11% rent growth, that unit is going to have an 11% loss to lease. So you can see very large loss to lease here of almost 400,000, and then we project to slowly burn that off, which obviously creates a lot of value, and really isn't a difficult projection to make because these market rents are being signed every day in the market and at this property. So it's just a matter of time for this loss to lease to burn off. Vacancy, however, is definitely something that we can improve on. We're being somewhat conservative with our projections, but the property is underperforming the market from an occupancy standpoint. But in year 1, to be conservative, because of our business plan, we are projecting actually vacancy to go up, but then to go down and then to get tight into stabilization. As I mentioned, our CapEx budget is heavily weighted towards the interiors, and you can see that here with about $1.5 million scoped for the interiors, and with some minor things outlined by our operations team and our GC partners on the exterior. But really, the $2 million budget, like I said, most of it going towards interior to create a lot of value. Here we have a couple sensitivity analyses for you. You can see here exit cap rate is sensitized, and then rent growth is sensitized. And obviously this is not the total range of outcomes, and we're not trying to say that it is, but just if you look across the sliding scale, if rent growth is more muted and exit cap rates really gap out to 5.5%, which is very high for product of this quality. The projected 3-year IRR is 5.1%, which is still positive, which is great. The reality being, if we were in a downside scenario like that, there wouldn't be such a strong incentive to sell, and we would likely not do that unless we really felt that it was, the best move than just holding on for cash flow. That's kind of the best part about owning private real estate is you don't hopefully have to be a forced seller and sell at the wrong time, like what might occur in the stock market. And then, of course, the upside is always the upside. You can always get more rent growth. You can always get more cap rate compression, and you can always get higher returns. But, we really like to focus on our realistic projections and the downside protection. Similar story on the equity multiple, same sensitivities, similar numbers. And then cash flow being very important as, both a source of return as well as a risk mitigant. We want to stress cash flow and look at, really to cut to the chase, as I mentioned at the very beginning with the debt situation, at that 6% rate ceiling, we still have positive cash flow with average cash on cash about 3% over the whole period, assuming just 6% throughout. And that's really a good place to be, and I think an important thing to look at these deals. Oh,
we can both control at the same time, it seems like. I was wondering about that. Well done, Rob. We're gonna get to some questions, but first, just want to kind of go over some of the next steps moving forward. There's going to be a link to the portal where you can read over the private placement memorandum and subscribe to the deal. And by the way, this webinar is being recorded, so you're going to have a link to the recording as well as the entire investment summary to go over on your own time. You'll also be provided with funding instructions. You can see the funding deadline is July 12th, but I encourage you to not procrastinate because we usually fund well before the deadline. Many have already placed their soft reserve, so I encourage you to move forward if you do have interest. And once you've invested and become a partner, you'll receive monthly progress reports as well as quarterly financials. You'll start receiving monthly distributions after the first full month of ownership, and your preferred returns begin to accrue the day of closing, and we're targeting closing to be July 28th, end of July. We definitely pride ourselves on our communication and transparency, so we're always available if you have any questions that you need answering. There's my contact information. You can reach out to me at rick@fortressfederation.com. There's my phone number there. And with that, we're going to open it up to Q&A. I can answer a few, Rob. We can kind of go back and forth. In terms of Chris's question, Rob, I'll let you answer. Well, you did answer that. And I was impressed with that. We really had no reason to. I think we moved up from a 4.5. I think the prevailing market cap, Chris, is 4 in the area, and like you say, it's 10 basis points per year. That's 2.5 times. At 4.75, that's about 2.5 times that. So pretty conservative. Why don't you go ahead and answer Mark's question there, Rob?
Yeah. So I mean, when tenants, when prospective residents go look at units, they're not looking at units from a square footage perspective. Like, they don't see units from 750 versus 820. And so there's a bit of a slack there. There's not a perfect relationship between square footage and rent. So we do feel comfortable, given our renovation scope, to achieve those pro forma rents in line with comps that do have larger units. Jason wants me to repeat the question, which was the question about 1 bedrooms being small relative to the comp set, yet we're targeting to have rents in line with the comp set, in spite of the disparity. And then going back to Chris's initial question, he was asking what our exit cap rate assumption is. And our exit cap rate assumption is 4.75%. And as Rick mentioned, the market cap rates are definitely going up, have definitely gone up. And I would say today, for this type of product, you're looking at high 3s. And so, given our exit cap rate of 4.75, it's a good buffer there, well in excess of the kind of typical 10 basis points per year, benchmark.
Yeah, I would add, a lot of underwriting is done over 5 years. So you'll see like a current cap at 4 and an exit cap at 4.5. So, basically a 0.10, 10 basis points a year. But remember, this is only a 3-year hold. So it's 25 basis points per year. Pretty healthy. Let's see. Nick just he was wondering what the current vacancy was. We're about 10% and 9.6% last I checked the underwriting. NOI is 1.2 million, and gross income is 2,717,000, about 2.8 million. And then he's got a good question. What was the reasons for the initial group's failure to close?
Yeah, so it might have not been clear, but the other group never really had a chance to close per se. They never had it under contract. Basically, the seller changed their mind. The seller saw what they originally awarded the deal to the other group, and then didn't like what they saw as far as their PSA negotiations and the way they conducted themselves. So they were looking for really more of a sure thing. And so that is, through a reputation with Berkadia, it really helped the deal come our way.
Okay. And he asked, a good question. What are the downside risks? I think you covered a lot of it in terms of getting the rate cap, the 1-year extensions, and we talked about the cap rate. Any other downside risks you might mention?
Downside risks. Yeah, I would say all the downside, not all, but the downside risks that I see are incremental. So I don't think there's, really much risk that I see that that could cause us to have a major situation as far as a capital call for sale or anything like that. But it could be a situation where, we don't quite hit the performance that we want. We don't quite hit the occupancy rate that we want. And, the, small things that reduce cash flow and total return. But I think the main risk that we're always looking to avoid is, a permanent loss of capital. That is something that we never want to endure. And I think our purchase price, our business plan, and our debt are all well positioned to protect against that.
Good. Andy asked what the plan is after a 3-year hold. Is it refinance or sell? And there's no refinance underwritten. Never is when Lone Star is involved, which is good. And the plan, theoretically is to sell, but of course we take a hard look at a refinance. Jason asks, your vacant sensitivity doesn't extend to the current vacancy rate. Will you cash flow positive at the current rate?
Yes. Yeah. So if I'm looking at, we actually look, our underwriting actually for month one has $5,000 more dollars in vacancy than their current monthly vacancy rate. And we are still projecting to be cash flow positive in month one.
This came from Nick earlier. It's not on here, but he asked, will there be any more required capital from investors? And that's kind of covered in the PPM. And basically, there's always the chance of a capital call. We don't foresee that. Don't see that much, if at all. And no investor is required to provide additional capital. So basically, your one-time investment is your one-time investment. This is also from Jason. What is currently holding the vacancy rate below market currently, and what are the salient improvements you will make to drive it down to your target?
Yeah, I think a lot has to do with marketing and kind of the softer things that are harder to see. From our tour, the manager on site is less experienced. She's very energetic. We may decide to keep her on, but the team didn't look that robust when we were in the office, and that's obviously very important. And given that we have local experience, local team, and corporate team all in the market, we can really be aggressive with marketing and making sure that we are hitting all of our KPIs as far as leads, tours, conversions, renewals, things like that. So it's really, as cliche as it is, we're basing our business plan on better management of the property, which is a tough sell, I know, and that's why we love our Verandas at Bear Creek case study, because really without spending much money on the property, we were able to take the property from 80% occupancy to over 95.
Yeah. And, oftentimes when investors are doing their due diligence, they'll go and they'll see the Google review or whatever on the current property. And they'll be like, well, it's only got 2 stars, and just remember that's not our management. And that's just opportunity there to improve upon what's there. So there's usually a reason why vacancy dips down, and that can be helped. Let's see if there's any more questions. This is your chance, ladies and gentlemen. Get in your questions. Here we go. Lone Star typically focuses on B and C. Is this Class A intentional based on market conditions?
Yeah, so I wouldn't say it's intentional based on just the most recent market conditions. It's kind of a general trend that we've been on board with for the last at least 2 years now, which, we really felt that risk premiums have gone down across, heavier and heavier value adds. So, our earlier deals were heavier value adds because we felt that we were getting paid for that risk and effort. And then, all the way till today, I think it's even more true today, but it's been true and it's even more true as far as buying quality property in quality locations with strong financing to really be the best performers moving forward. So, while this deal is Class A, it's really Class A workforce housing. I wouldn't put this deal in a category of renter by discretion. I would still say these are people that are mostly renters by necessity. So it still fits our workforce housing box.
Okay, well, here we go. Andy, how much of the GP have invested in the deal? I think we're about 10% overall, right? Which is pretty healthy.
Yeah, so, we invest in all of our deals, and we also, our employees invest in our deals. We have an employee program that encourages and rewards our employees for investing. And then our families invest as well. So, we're very active from that standpoint. So that's where we're at.
Chris followed protocol. He's the first one who asked a question in the Q&A. So we got to reward Chris somehow. But it's a good question. Is there risk with the bridge lender not granting the 1-year extension, or is your risk mitigates with the lower initial leverage? Maybe is your risk mitigated with the lower initial leverage?
Yeah, so the 1-year extension is subject to a DSCR test. So it's not as of right. There is some fine print there, but because, as Chris said, we are going in with the lower initial leverage, we would have to see a material decline in performance to not pass that test. So it's not like a razor thin margin for that minimum benchmark.
Okay. I know you guys are a fairly young company, so weren't around 2008, but I assume you've talked to others that were. Are there lessons from that period that you're building into your business plan here? If I would just say this isn't directly answering the question, but this is definitely different, a different situation. I kind of harken back to some of those graphs that I showed earlier. Incredible amount of supply of money, an incredible shortage of housing, and the lending is in a lot different situation, and it's also by submarket as well. Texas performed pretty well, and actually multifamily performed a heck of a lot better than single family in terms of default rate. But yeah, Rob, have you spoken to others? Are there lessons from that period that you're building into the business plan?
Yeah, I think the single biggest thing by far is just the debt. So the lower leverage is our response to the market environment. But I think, as far as there's a difference between, your business plan and actually going through it. And I think our team, particularly Kent on the operations side, who watches everything that's going on like a hawk, and Josh is all over everything and super competent, and they're doing, just the other day we were working through interest rate analyses across all of our portfolio and looking at, the projected interest rates in the future versus our projected rates in our model versus the market and the way that's shifted today and things like that. Actually going through it, having to throw the business plan out the window sometimes and having to adjust is really how you show yourself to be a good operator. So I think that's unfortunately, right? Like as so many people say, you have to go through it to really know it. But I think our team is, so far we've been through the COVID thing, and we've had individual property issues, and all that stuff has been great opportunities for us to perform, be transparent, and build trust with our investors.
Some good questions. Okay. We are coming up on the hour. If you have other questions, go ahead. Put them in. You can put them in the chat if you want. But that kind of looks like the end of questions for now. As a reminder, we'll be sending out the recording, the investment summary, and a link to the portal where you can subscribe and fund the investment. Again, if you're interested, I encourage you to take the next steps. And if you have any questions, we are available. So no problem there. Other than that, let's see. Wait. We got another question. Can you show the rent comps? Those were skipped. Let's see here. Again, this is all going to be, you guys will have access to this. Yeah, you're all going to get your own copy of the investment summary. What would you say is it Westmount at Hollow Tree Park? What's the closest comp we?
Yeah, that was the deal I pointed out on the map.
Yeah. So yeah, about 150 or so behind that. And when you say we're getting those rents right now on the previously renovated units, what are we improving upon their renovations? We are, right?
Yes.
So there's a good chance we're going to command more than that $150, or at least they're going to be more attractive, more desirable than what's there. So there's a good possibility we could attract a higher rent. If anybody has any questions on that rent comp, but yeah, that's going to be available to you. Yeah. Okay, we're going to wrap it up here in a few minutes. Just want to thank all of you that came on the call live, and definitely thanks for getting those questions in. Hopefully we've got most of the questions answered. Again, if you have follow-up questions, just let us know. Rob, thanks as always. You did a great job, my friend. Anything you want to add?
No, that's it. Thanks for bringing me on, and thanks everyone for tuning in.
Yeah, thanks everyone. You guys have a good night.